Thank you very much for joining us today. My name is John Stenhouse. This is the University of Essex, our Space to Grow programme on investment readiness, where we investigate all the issues regarding raising investment finance for your innovative business. So today I have with me Josh Clark, who is going to assist me with this webinar. And I also have William Millar and Nitin Patel. These are our two entrepreneurs in residence who work closely providing mentoring support to businesses, entrepreneurs who are seeking to raise investment funding. And that investment funding can be anything from a few £1,000s to a few £1,000,000. So these are very talented guys. And trust me, they've seen it all, but they won't tell you that. Everything is a complete and utter surprise to them. So without further ado, let me introduce you to William Millar and Nitin Patel, and I will ask them to share their screen with you. So please share your screen.
So good afternoon, everybody, and thank you for attending, and thank you for the opportunity for us to speak to you. This afternoon, we're going to talk to you really about what investors would like to see through the contents and structure of a pitch deck. So the agenda for this afternoon is we're going to, before we look at equity investment in more detail on how you structure that pitch deck, we're going to ask you the question, is equity investment the right thing for you? Because it doesn't necessarily suit everyone and it doesn't necessarily suit every business. We'll go through then the contents of the deck and we'll summarize at the end. So to look at this very first question, is equity investment right for you? What it means is that you are selling part of your company in the form of shares. So remember, this is a sales effort that you're going into, and your company has to have shares that you're able to sell. So that means that the company structure has to be right, and any existing shareholders must agree to sell some of those shares as part of the investment. Now, if you go down this road, it brings others into the company, which means you've now got a different relationship and a different dynamic that you have to accept and you have to manage. Investors may be coming just to give you money, but more often than not, they'll be coming to participate in the business in some way or other. So it's no longer just you and you running the company. You have a responsibility to those shareholders, and you need to be able to work with them, keep them up to date on what's going on, and listen to their opinion and their advice. Investors will typically be looking for a 10 times return on their investment in a few years, say 5 to 7 years, or it could be less. And you need to look at your revenue forecasts and see if you can support that kind of return so that you're in a position to give them the invested money back again. Remember that other forms of investment are available to you. You don't have to seek equity investment. Don't just think that you're starting a business and equity investment is really a badge of honor that I must find and secure. You can go into business with debt finance, and you can, in certain cases, get some grant finance to support the business. I have to say that in the latter case of grants, it's usually difficult for a startup business to secure a grant simply because it hasn't got a trading history to rely on. But in some cases, you can get a grant, especially for technical businesses. And overall, remember, it's a journey you're starting out on, and there will be bumps along the road. There will be decisions to make, discussions to be had. So be prepared for that journey as you start out on it. Moving on, I'll hand to Nitin to take over at this point.
Okay, so I'm going to go through what we call your sales pitch. It's also known as the investment deck. And we call it the sales pitch because that's what you're doing. You're selling yourself, your business, and your solutions to a set of investors who will then hopefully invest in you to put this program of work and ideas together to create value out of the business you're going to start up. So if you look at this, there's 11 items that we have put on there as the key points that need to be within an investment deck. You can see the summary there, and we will go through each one of those. And around the sort of target is around 15 to 18 slides, depending on the complexity of the business, specific areas. but it should be no more than 18 maximum to try and get your story and your requirements across to the investors. So I'll go through those one by one. William will help me along, and hopefully you'll get a good idea of what we expect within each one of those titles. Okay, so the first item that really needs to be identified and really communicated to anyone who's looking to invest in you is the problem that you're looking to solve with the idea that you've generated. It's very hard actually to get that across unless you really understand totally. And that's why we talk about making it real, describe the problem in a simple and concise language, and make sure that you know where that problem exists. If it's from a personal experience, it's much better because you'll know it inside out. And Bill, do you want to add anything else to that?
I think from my perspective, it's try and couch the problem statement in words that the investor can understand, because you may have personal experience and you may know about the problem in depth, but the investor may or may not have the same knowledge as you have. And hence it's important to be able to present it in such a way that the investor can understand it, can relate to it, and can recognize it as a problem. You can assume a certain amount of knowledge from the investor, but don't assume they have got the same detailed knowledge as you would have.
Okay, so the next point really is then identifying the solution to the problem you've sort of raised as to requiring the solution. So this is really the second key point within this document, because you've got to get across the solution you propose, why it fits the problem you've identified, and also the case that it's a workable solution. And it clearly needs to be expressed in understandable terminology to the receivers of this document. Bill?
I think the other thing to say, and it may be an obvious statement, but does the solution link directly back to the problem? The problem will have set up where you're going to effectively set your business against by providing the solution. So you must make sure that that solution matches the problem and addresses the need that you will have identified in the problem statement itself. I think it's also worthwhile saying that you shouldn't really put too much technical jargon and abbreviations in here. Just make sure that the investor can understand what you're doing. Of course, there's a balance to be struck, because if you're providing like a software as a service platform to address a particular need, then it's okay to talk about a SaaS platform or something like that, because most investors will now understand what that is. And trying to describe it in some simpler terms is quite difficult. So trying to make that abbreviation or that acronym be simple makes things complicated. So it's, strike that balance. And the other thing to say was, once you've got the solution statement in place, it opens the door to a number of why questions. So why is your solution the best? Why are you the best place business to deliver it? And why now? And why will people buy from you? Now, you don't necessarily have to put those all at this point in the deck, but be prepared to have answers to those either in the deck or when they get raised by the investor.
Okay, the next key item in there is how much to invest. And this is you actually going to your potential investors and asking them for an amount. And some of the key areas that needs to be covered when you're looking for investments are points around: what is the total amount you want? What do you think and believe the value of the company is at that point? And I say what you think because you have to do the research. If it's new, you have to do the comparisons. You have to make the value realistic. So when you get the amount that you're looking for, they understand the percentage equity that they will get as a result. Now, this is quite complex depending on industries, but it's something that you're going to have to work with and be realistic in assuming that the value is the amount that you perceive it to be, and be able to justify it. And as I said, the next stage of that is how much, and the amount you need needs to clearly be defined on where it's going to be used within the business, so they know that you're in control of really getting this money and knowing exactly what to do with it when you get it. So the program, once you get the money, is up and running. Bill, do you want to just cover some of the other points there?
Well, I would just emphasize the point that you made, that you have to be realistic in what your evaluation is. And sometimes it's very difficult to get a valuation, particularly in an early stage business. You'll be talking to perhaps lots of investors who may think that your company's worth £1 million. But if your investors, if you talk to several of them and they say it's worth 200 to 300K, then they may be trying to tell you something. So be prepared to listen to that. The other thing to make investors aware of is, how many rounds of investment do you think you're going to need? Because that in turn impacts on how the shares will be diluted over time. And it will also give an indication of how much time you think you're going to have to spend raising funding versus working on the business and growing it. And you may be looking for an investor not just to provide money, but also to provide something else, some soft skills around that. So you may be looking for somebody who's got expertise in a particular area, or somebody who can bring in their network and their black book of contacts with them. So be clear what it is that you're looking for to accompany the investor or to accompany that investment, as well as purely the money that's coming with it.
So as we said in the last slide, that looking for investing is part of what the whole pitch deck is about. But within it, you have to be clear about where the money is going to be used. So there should be a very good in-depth analysis of how you intend to spend the money, what you expect to get as a result of the money, how quickly the additional funding may help you to get revenues, not to the extent of forecasting undeliverable points, but to a fact that you give them a good view that, with this money, you know exactly where you're going, and the fact that this will allow you to start progressing in a targeted manner. And that is clearly one of the key items when people ask for money, to know exactly what they really are planning to do with it and what will result from spending that money. Bill?
Yeah, the key thing for me is that last point. What is going to come out as an outcome of that money going into the business? You probably will have built, if you like, a budget bill saying that we need so much for salaries for new people and so much for equipment and so much for marketing. But to me, those are all inputs into the business. What you want to do is understand, as a result of that spend, how is that going to impact on the growth of the business? And the other thing is make sure that you can justify every item that you're going to spend money on, because that's what the investor is going to give you in his or her investment. So they will be prepared to ask you questions of why do you need it and what are you going to do with it.
Okay, so everything we've talked up to this point within the pitch deck is mostly in your control. You define what the problem is, you've defined how the solution is, how much you need to get you moving. This is where now your investor actually expects you to know the outside world that you are going to deliver your business set into. So this is all about knowing the market, knowing the size of the market, knowing what part of that market you are particularly aiming for, and within that segment, what is your realistic view on how much you can actually take off that market. And this all depends on a number of things as to how early the market is, whether it's very new, whether it's an existing market that's been around a long time, but the specific niche segments that you can work into, and the size of those can be quite sizable. The hardest thing here is to actually work out what area within a complex market that you're aiming into, where your sweet spot for your business is. But it's an opportunity for you to make sure that your investor knows that you've done the work. So there's never enough market analysis. it's how you get it across onto the slide is really a key to this, and making sure that the numbers you're talking about are from sources that are easy to reference. Bill?
Thanks. For me, the key point is that it's relatively straightforward to take a total addressable market of several £100 million and divide that down by a percentage of how much is that you could, there's the service addressable market and how much you might be able to obtain. So you get a percentage of a percentage of a percentage. Well, that just shows you that whether the market is big, but it doesn't really tell me or anyone, how you're going to reach into that there and how many customers you're going to get. So I like to see it being built from the bottom up, because I come from an engineering background. So things like who is your ideal customer, you will have done some of that in working out what your solution is. But then how many of those can you identify that you actually know about and are within your reach? How many are similar to that? And can you then sell to them? And you think through it in terms of those kinds of statements, so that you can see that I can build up from my starting point to a number of customers over the next month, to some more over the next month, and so on, that you can see that you have got a realistic projection about how the business is going to grow. And then the other thing you're going to concern yourself with as well is if there is a market in there that you can address and you're going to sell into, you've got to worry about how long will that last, because there may be no competitors now or little competition, but how long will it take people to enter that and do the same kinds of things as you're doing? And then what will happen that will change that marketplace? What's coming along that will disrupt it? Is there new technology or is there new legislation or whatever that means that that marketplace doesn't last for very long? And how are you going to respond to that?
Okay, so this follows on from the last slide on the basis that now you've sort of worked out what your market size is and where you sit within it. There's an expectation now for you to sort of be able to predict the sort of engagement within the market that you were able to make over a period. And this is what this revenue projection is about. So you've got to do the things that William just described in terms of knowing and how you build and the pace that you can build the market share. But that then has got to be translated into some numbers which are realistic over a period. So in some cases, big markets, a small percentage means significant numbers in terms of pounds, but be realistic about whether you could achieve those sort of numbers because there'll be quite a lot of resource requirements. And in the short term, you might not have the ability to get all that resource on because you haven't got the investment to require the matching numbers to create the revenue generation. So this is a little bit about crystal ball gazing, but more about your understanding of yourself and also the business that you're trying to create and how quickly you can work to engage people within the market to start buying off you. And this is the basis of quite a lot of things that will determine whether your investor wants to invest in you and at what point does he want to invest in you. Bill?
Okay, the key point for me here again is make it be realistic. So say that you're going to generate £300,000 of revenue in year one, and each customer spends on average £1,000. That means you have to have 300 sales in year one. And that means approximately 6 every week or roughly 1 every day. So can you see a way of selling to 1 new customer every day on average over that year, and use that as a back of the envelope calculation to fact check your revenue model itself? And then don't forget that as time goes on, you will have new entrants and competition coming into the marketplace, and you will churn some of your customers as well. So you don't have full control over the market. Some things will change, so make sure that you can try and build those projections. And it's useful to do that in a model in Excel or something like that, where you can then adjust some parameters and ask what if questions. What if there's a new competitor coming in? What if our churn goes from 5% to 10% or something like that?
Okay, so as the deck is progressing, you will see more and more of the items that are required are actually not in your control. So now we have to start looking at how we market the business, and how then we create sales. And they're two different things. Within a small business, a lot of people talk about sales and marketing as a combined function, but the activities they do are two separate items. One actually costs money, which is marketing, and the second brings in money, which is selling. So the key here is actually really understanding what target you're aiming at with your marketing, finding the right channels that will get to them and make you stand out within that channel with your marketing, PR, and your sort of continual use of technology. And as we've said here, one of the areas more and more involved in this is digital marketing, which on the one side, for most younger startups, is easier to do because the cost is reasonable, and the ability to control that within yourself, as long as you've got some creativity, it is reasonably done. The traditional form of marketing is quite expensive at this early stage, but it may be part of what you need, and it may be part of what you're seeking investment for. So it's still very important that you understand how you're going to market yourself, and what cost would be incurred in doing that, and what you see as returns from those costs. The other area on this slide is about sales, and this is about getting money into the business through providing either the product or the service that you've defined that will now have customers. And this is an area where, again, it's very hard for young startups because you have a limited amount of resource, and how much of an area or the market or region do you cover in terms of getting your message across to those people. And that, again, is a strategy in itself. It's deciding how best to get that information to the right people who are the decision makers. And that's why they're two separate functions. One is to tell them what you do, and second is to work with them as to why they should buy what you do off you. So, Bill, do you want to add more to that?
Well, I think in terms of marketing, and it's something we've said a couple of times, is know who your customers are, and consequently, if you know who they're likely to be, then you'll know where they exist, where they hang out at, and hence that will drive your marketing effort. So, if you're marketing a product into the construction industry, I would suggest there's probably not a lot of benefit in trying to market that through Facebook. You want to do something else. And as Nitin says, marketing is a cost in the early days, so you've got to be very careful about how you spend that marketing budget, and understand and monitor it and see what feedback and you're getting as a result of it. In terms of sales cycles, be aware that if you're selling something into an enterprise, it's going to take a long while to probably close that deal. So enterprise sales can take maybe as much as 9 months, typically, from first engagement to actually closes. And be aware that enterprise sales may also be related to the enterprise's budget cycle as well, which could mean it could take another year until the budget is rebuilt. So revenue could take a while to obtain. So be aware of that. But be aware that once you start selling, that you've got to be able to support those sales. You've got to be able to scale up in order to produce whatever it is that you're selling and meet the customer's expectation in terms of delivery date, but also that you've got a good customer service organization in place that can deal with the customer and respond to their queries as time goes on.
Okay, so now we've talked about the market you are going to aim for. And if that's a big, lucrative market, then there's certainly going to be other people who are aiming for the same market to get revenue from. And this is where you've got to get the detailed knowledge about who you're competing with. And one of the slides in there needs to be showing your understanding of where the competition is, what they can do in comparison to your solution, whether there's key areas where your solution is better than something that's already in the market. Now, most of the time, people will believe that a new startup idea will not exist. And that really isn't true. In various forms, there will be an ability within the market you're aiming for to achieve a solution. So a lot of times, the reason the startup gets traction is because they're either going to produce the solution in a more cost-effective way, a much more beneficial way in terms of speed, output, and other things. So I wouldn't worry too much if when you do the competition analysis that you find someone's got an idea similar to yours. You should get to understand the detail, see if there's things you're providing actually adds more value than their solution. But those are the things that would be expected of you from your investor. So this sort of one slide covers a lot of work that you would have done in getting to this stage of developing a scenario where you're in a strong enough position to go out and look for investment. And you can see some of the things that are in there. You know, do you have a patent? Do you know people who are going to buy off you? What are the competition selling? So it's really detailed knowledge to get the message across that you understand the market you're getting into. Bill?
Yeah, I think it's not uncommon for people to say there is no competition for what we're doing, and that's usually not the case, because there'll be something, if not directly like it in functionality, there will be an alternative way of meeting the need. So you've got to understand, as Nitin says, in the detail of what it is that you're offering and how does it compare against everything else. And then what, as a result, what are the unique features that you are offering that others don't, that will make them come and buy from you. As time goes on, things will change. You need to know how you're going to keep ahead of that competition. Remember too that investors will see lots of pitch decks coming to them. So even if you're not aware of any competition, the investor may be aware of competition as well that they'll see. And in terms of IP, quite a lot of people, if they come up with a new idea that is patentable, they will rush out and patent it. But just be careful of that, because I've seen businesses who go in the early stages, patent, spend a lot of money producing patents, and then run out of money to take things forward. So just be careful that you understand what your strategy is towards IP and what you're going to do about your patents and whether you're going to patent or not. Make sure that you've got a unique name and a unique logo that you want to preserve. Make sure that you've looked at trademarking it. And equally well, look at trademarks to make sure that you're not infringing unknowingly somebody else's trademark, because that can be a failure at the outset. You can spend a lot of money building up a brand, and then somebody realizes that you have inadvertently infringed their trademark. So be careful about that. So provide that information to the investor that you have done those searches and that you understand your competition, your IP strategy, whether anything's been trademarked or not.
Okay, so now we've got to a stage where we've determined the problem, got a solution, understood the market, worked out that we can get some revenue from it. But part of getting the revenue and making a clear profit is understanding your costs. And one of the areas that we said the deck should be looked at is also providing some expertise that you may need. And this is one of the areas where I think an experienced investor can help a lot for early stage startups in understanding, getting the sort of message across to the market and to yourselves. What is an acceptable cost for the service you're trying to provide? How do you sort of ensure that the pricing that you put in as a result of the cost allows you to be competitive and acquire the sort of customer rates that you need to maintain the growth of the business, and also looking at how the different models can work within a particular sector. In terms of software, there's been quite a lot of different ways of people coming up with how they make money in selling that information, and the sort of creative software that they've used. And the number of different ways will work, but it also depends on the audience you're looking at. And corporate companies will look for something different to small businesses, to individuals. And that's why it's an area where it's very important that you get it right, but it's also important that you understand what the market will stand as a model for you to work within, unless you've got something totally new, and you can sort of break the market. And that's, as we know, has happened more and more recently online. And some of it's around reducing the cost of doing things. But it's very important that you understand your own costs to be able to work out where you can price things to get you traction in the market you're aiming at. Bill?
I think the one thing to add is that it's more difficult to start with a low price and then increase it than it is to start with a higher price and reduce it. So make sure that you understand exactly what your model is that you're going for and be able to clearly articulate that, because investors will drill into it, because effectively your business model is how do you plan to make money? So investors putting money into the business expecting to get money out will want to understand how you as a business are going to make that money in there.
Okay, so we're getting towards the end of the pitch deck in terms of the content, and we're now talking about the team. Now, this is towards the end, but it's one of the keys that the investors will look at. He, in 9 times out of 10, in an early stage startup, will say he's investing in the people. The idea that the people bring is part of that, but certainly how the people are put together, what their sort of understanding overall, their background, their experience, their ability to show that they're, from a background or done things that have resulted in significant value being added to any project they've worked. Now, that doesn't mean you write a CV for every person in there. You put the key relevant points in, particularly if they're sort of very high tech scientific startups where, people with that in-depth knowledge would play a good part in developing a business. And it's right for you then to tell the investor that the reason you feel confident about being the guy who discovered the new areas within it is because you're working with a team that has been working in that either through education or research. So it's got to be delivered in the right format in terms of your audience. That's certainly a big key to gaining investment. Bill?
Yeah, I think one of the things that we haven't talked about at all is because we're talking about the content of the deck, but also when you come to pitch, if you're pitching in the front of an audience, that audience of investors will also be looking at you as a person and the team that you have around you. So they'll be looking for factors such as, your integrity, your passion, your experience, knowledge and skill, how committed you are to this business. Whether you're coachable or not. Every time they ask you a question, do you jump in with the answer before they explain what it is that you're doing? So there are a whole pile of soft areas around the team that will come out if the pitch is presented to an audience. So be aware that that's happening as you're speaking to the audience of investors themselves. And so just be careful of that.
Okay, so we're now moving towards the end of the deck, and we now talk about where you are with your particular program in terms of how far have you got without this investment, or how far have you reached with a previous investment. And so this is about the current status while you're going in front of the investors. Now, there's a number of ways this can happen. You can include some of the key areas that we say you need to ensure that they understand within the deck in the relevant places. So, if you're talking about sales and you're talking about a slide with sales, you can talk about the customers and some key customers you work with within that slide. You could talk about the trials you've done. If you're looking at trials for investment purposes through grants, then it's also important that you tell them that you've actually got some grants if you have, because it gives you that ability to show that someone else has already audited your proposal and are willing to fund some of the areas of that project. So it can be quite varied as to the status of the project you're in and what you give, depending on what stage of investment you're looking for. But you should include some of the key areas that will interest investors to ensure that they're getting in with a business that has already got some traction. And some of these things that we've highlighted here, and if you've achieved to make progress with them, shows that you're getting traction. Bill?
The key, for me, this is a key slide in that it gives you validation of everything that you've been talking about. So if you like to think about, you've identified the problem, you've identified the solution, you've seen how you stack up against competitors. That's one aspect of the business. You have got another aspect of the business, which is about your customers, your sales and marketing strategy, your revenue forecast, and your business model. So that's telling you how it projects into the future. But your current status is actually saying, what have I done? And has that been validated by customers? Have I sold something to customers? Has it been validated by other people looking at what you're doing in terms of, say, a grant application that's been successful? Or have I got any awards as a result of other people peer reviewing what I've done? So this current status, and or sometimes called the traction slide, tells you exactly what is happening in the business, how I've got to where I'm at, and where I'm likely to move in the future. So it validates everything that has been done, and hence for that reason it is very important to establish that in front of the investors.
Okay, so just now summarizing what we've sort of gone through, as we said, the pitch deck is about telling the story to the investor of why you're bringing to him something that will make value, it will be of interest to him, and something in some cases, if it's to a relevant subject matter, that they are interested in coming to understand more by being an investor. And as we said, one of the key to getting a good pitch deck is understanding yourselves about the market, about the competitors, making all of them flow through the deck to tell your story. We use the word story on the basis that it needs to flow, and everything you talk to him about, it follows on from one to the other in terms of why it's a well thought out plan that you're putting in front of him for him to then consider and invest through giving you money to make that plan come to reality. So it's really about making sure that all the slides you have the opportunity to use, and we said between 15 and 18, are all gained towards that end story of, this is the reason why I've got a good idea, my solution will work, there's a sizable market that I can work within and get quite a significant amount of, but I need some help with your investment. And that's what the whole thing should be about. Well,
yeah, although we've split it down into the content and the slides that would contain that content, remember that you are telling a story, and that story has to follow a logical progression that is coherent. So if you're putting numbers in it, make sure that the numbers are coherent from one slide to another. Make sure that anything that you say you can justify, and that it is a truthful statement. It's not something that's been made up. Don't make the investor think. Make sure that you lead them through it and you give it, as complete an answer to any questions that they might be asking in their mind as you go along. So make sure that you review and rehearse and war game that slide deck as with others, with friends or with family or whatever, to make sure that it's got that self-consistency about it, and that you don't expose or create questions that are unnecessary at the time you're presenting it. Make sure that they're all closed down as you go along, so not making the investor think. And it's important as well, if you are got the opportunity to speak to a specific investor, do your research on that investor themselves. What is it that they invest in? What's the attraction for them? so that you're more likely to engage with them. Some people are more interested in the team, some people are interested in the technology, some people are interested in the market and how big it is, but understand all of that from the investor's perspective. And ultimately, at the end of the day, it's your business, it's your sales opportunity. You don't have to sell to anyone if you don't want to, so remember, it's still your decision at the end of the day. And I think at that point, we'll conclude. And if anybody's got any questions, drop them on the Q&A. Any follow-up, you can get to us at the University Enterprise Zone email address, which is on the screen, uez@essex.ac.uk. And I thank you all for attending. Thank you for the opportunity that you've given us to present to you. I hope it's been useful and sparked up some ideas in your own head. And I'll pass back to John now.
Thank you very much indeed. That was entertaining as well. I've got a couple of questions that were coming through. Let's talk about runways. Is there any kind of perception as to how much runway a business should be asking for funding for?
It's a difficult one on the basis that if you've done your work in terms of all the things we've talked about and are within a sort of reasonable area of achieving it within 10, 15%, then I would say at the stage of looking for investment, you're looking for around 18 months worth, because most business would take a good 6 months once they enter into the market to try and get them some traction. Then they need to work through customers and hopefully they can show some growth. But that's quite a lot in a sense, because if you're not sort of looking at using the money pretty quickly in terms of some key areas that you are focusing on to improve the growth, then there'll be quite a lot of questioning. So it's about, the type of business. If there's a view that it is a longer term in terms of incubation, then investors would accept. But I think more than 18 months, you wouldn't succeed. Less, preferably the better, because it speeds you up to get to revenue stage.
I think if you go for too short of a runway, that means that you're going to be spending all your time raising funds, because you will no sooner have raised funds for, say, a 6-month runway, then you have to start raising it again. So you're spending all your time doing that and not developing the business. And as Nitin says, if you go for a long runway, well, that's a large amount of money. All kinds of things can change within that. So you have to try and seek that balance, which gives you a runway that means you could got effectively achievable milestones that make sense to investors relating to the growth of the business, which allows you then to go back and ask for more money at a later date. I've achieved these milestones. I can now see a way ahead to achieve some more milestones in terms of growth, revenue projection, overseas development, or whatever. So try and work out what the strategy is, where those milestones are, and then what amount of time it's going to take you to achieve that, and consequently, how much funding do you need?
Thank you. I mean, say that there's another area which was raised, which is about CEO salaries. And of course, no investor really wants to pay for the CEO for his salary. They really don't. They want to pay salaries for those people who are actually going to produce the work. In other words, the workers who are actually going to generate everything. The CEO is there to pilot and steer. But when it comes to a CEO salary, I would say in those early days, often CEOs work for very little indeed. Have you got any comments on that, William or Nitin?
Well, I mean, there's two areas though, isn't there? That one, it sort of depends on how early the stage is. And I think in that case, John, you're right. But I suppose if you're looking at the next stage where you've done some of the early work and now you're looking for a growth spurt and you're looking for a reasonably experienced industry CEO, then you've got to value that against what benefits is going to bring. So it's one of those where I think an early stage startup, you follow John's view, and it's all about how much equity and how much that will be worth to you as you make the business grow. If you're at 4 or 5 years down the road and you're looking for the next stage of your growth investment, then you see if everyone within the team has reached the level that they can't achieve everything because, you know, they've been involved with what's been going on in the business, and you might need to find someone from outside. And that's where you need to start looking at the sort of industry standards, which in a certain case, they're available, but then be realistic on what you can afford, because there's no point in getting someone who's going to change the world and pay him the money, but then the inability to actually sustain it. So it's a challenging one.
Yeah, I think for me, it's about risk, managing risk. You know, in the early stage of starting up a business, well, the investor isn't wanting to take all of the risk. So why would they be paying a CEO for their salary? The CEO should be taking some of the risk, and that may be putting their time into the business, or indeed putting some of their own money into it as an investment. So risk is high, but the risk should be shared. But as you move further down, then the risk becomes lower, and your risk of failure probably is couched in not finding the right CEO at that time. So hence you need to buy in that expertise to maintain the momentum behind the business. And that's an opportune time to look for them.
Thank you. So credit scoring, do they influence investments? Our experience is that credit scoring tends to be for the benefit of VC funds who are looking for returns on investment and that sort of thing. But in your experience, do credit scoring actually have any influence at all?
I've not known it to sort of be influential at the early stage startup.
And unless you're going for something like debt finance or something like that, where it may have an impact, but no, I've not come across it before.
Yeah, I mean, it really doesn't tend to figure when you're talking about equity investment. No. Credit scoring doesn't really work in that environment. So thank you very much, William and Nitin. Now remember, we run a series of webinars on investment readiness covering all the topics that you need to know about, whether it's the legal documentation that you need to work with, or whether or not intellectual property is appropriate for your business, right the way through to what's the difference between an angel and a VC investor, to do I need the enterprise investment scheme or not? So just remember, we have got webinars for you. We have a whole selection of panelists to present to you, and we look forward to seeing you at our events. So watch out on our events. uez@essex.ac.uk is our email address. Please drop us a line if you want to know more, and check out our website. So from me, John Stenhouse, the University Enterprise Zone, from Josh Clark, from Nitin Patel and William Millar, we'll say thank you and safe journeys. Okay,
Thanks.
Goodbye.
Bye.